Let me ask you a question. Have you ever seen an entrepreneur who's constantly winning and thought, man, what is that guy doing differently? What special sauce, what secret magic does he have that allows him to go from business to business? And every time he goes there, it's like he has the Midas touch. What is he doing that is so unique or so different that I can't do? How come somebody's able to raise a bunch of money and I'm here stuck doing whatever? Maybe a 9 to 5, maybe you're stuck doing a small business and you feel like you can't expand. I'm going to share with you in this video exactly how you should start thinking about your business so that you can grow it. Really, what we're going to do here is teach a lot of theory about competitive advantage, but we're also going to show you how to apply it to your business and how to apply it to your company. I'm David Grinberg. I'm the founder of Green Mountain Advisors. We're a special situations, private and public market investing firm. And essentially, what we do is we work with startup founders, private equity, basically everything across the board. We've done restructurings, and we are trying to create a video series right now to help founders, up and coming founders, second time founders, or whoever, anyone who's interested in business, learn about how we approach business and how we think about things so that you can improve your operations, and so that eventually maybe you can come to us and say, hey, we need some help from you guys. We like what you were doing and we're here to help. So essentially, this video will talk about competitive advantages, and it'll explain to you exactly how you should specifically think about every single action that you're taking in your business. All of this stems from creating shareholder value. Okay. We need to combine innovation with utility and supply advantages. Now, that's a mouthful. But really, when you create a company, you're saying, I'm bringing something new to the market that hasn't existed yet. So you are inherently becoming innovative. You're changing the way things are done. If you're not doing that, you should step out of the marketplace. You shouldn't try and compete on based on whatever everyone else is doing. You want to be an industry leader. That's how you create this shareholder value. That's how you improve your equity of your business. It improves the moat of your business. Utility. We want to increase the utility of the business. We want to say, hey, it's easier to do this. We want to say that it's a lot like Steve Jobs. He made the iPhone for a 3-year-old to use. You want to make the entire process of your business incredibly frictionless, right? And then you also want to have supply advantages. So for us, we like to play in markets where there are supply constraints, but we like to be part of companies where there are supply advantages in those supply constrained environments, because that naturally creates a price that is a baseline minimum. It creates a margin of safety for us as investors because we have this baseline where we know just from maybe geography, right? Like I could have a factory on a river, and then I could have boats on that river that get sent to market faster than anyone else because other people are forced to pull a horse and wagon to get to the market, but we can push our boats at volume, right? So we have a supply advantage. We care a lot about how much we pay for our assets, right? When you do a business, either it's a startup, maybe you bought a business, maybe you're investing in a public company. The number one thing to think about is the price that you're paying for that asset. Because you can have the best product, right? But if you're paying $100 for that product and you're selling it for 50 cents, it's going to take a while to just break even. But if I buy a product for $5 and I sell it for 50 cents, well, maybe I'm able to stomach that loss a little bit quicker because I know that the return is faster. So the price you pay dictates how much value you can generate, because simply saying, okay, I'm going to buy something and in 50 years I'll break even. There's a time value to money. You can't just say, all right, this is a really nice shiny object, I'm just going to own it. That's not how this thing works. And the next step for shareholder value, right, to essentially say I have a competitive advantage in my business, is it relies very little on the overall economy. You don't need your business to depend on the constant ups and downs of market demand. You're not at the whims of the market. You're not at the whims of the public. You're building something that essentially everybody needs, and there isn't much negotiation. And I'll give you an example. We invested in a company that relies on Microsoft's data servers, right? And once we built all this code, and we built all of this IP and all of these comments and everything around it, it's very hard to migrate off of Microsoft as a data provider once we've done all that work. So in the long run, they can tell us whatever price it costs to use their data servers, and we have to pay because we built our entire business on that, right? That could be a good thing, that could be a bad thing. But it relies very little on the economy for Microsoft because everybody needs data, right? And we really like technology because of that, because there are just certain unique principles that are in technology that make it very difficult for people to get off of it once they're on it, right? And that's what we want. We want recurring revenue. So very little reliance on the overall economy's health is very important. So when we look at a company, we're asking ourselves first and foremost, is there a market need for this? Does the market actually want this? Have you gone out, interviewed customers? Have you spoken to people? Have you done research, interviews, case studies? What have you done to prove that there's a market need? When a founder comes to an investor for capital, they should have this answer nailed. They should know, they should have at least 100 case studies saying, we interviewed 100 people, they all want this, right? We need a check for $10 million to start a facility or a plant, right? But if the investor knows that he will immediately start selling the product, he'll immediately start getting a return on his investment, he's more willing, he's more inclined to start taking risks because he knows that people will buy it. Nobody wants to go and create something and then nobody else wants it, right? You just wasted a lot of time, money, and energy. So is there a legitimate demand for this good or service is the first and foremost question we ask. That's the most important thing. Then what is the market size, right? Because this is the most common thing that a founder will come to us about. And this kind of ties back to the distribution portion. But it's like, oh, there's $1 billion total addressable market. And then I'll look at the founder and I'll say, okay, well, how much of that market do you think you can get? Well, maybe this much. Okay, well, how many of those people have you spoken to and started building a relationship with where once you launch your product or service, you can actually start selling immediately? Uh, Maybe $10 million, best case, out of $1 billion market cap, right? So, and this will lead into another discussion regarding acquiring other businesses, but that might be a video for another time. Essentially, you want a large market size, but as a first time founder, you're probably just going to, or even second time founder, or anybody that's doing a business, you want to have a list of people that you're already confident you can sell to. A lot of marketers, before they even have a product, they'll just start pushing advertisements out there to see what the market wants, right? So you have to be kind of scrappy like that and say, like, oh, what do people actually want? What are people buying to? What are they clicking on? The next thing you need to track is the frequency of purchasing for the goods and services. And this ties into a cash conversion cycle. So, what does that mean? It means the time it takes for you to buy inventory, to market it, for a customer to see it, to pay for it, for the payment to go through, and to recycle all that money again will affect the cash flow of your business. So you want to look at the frequency of purchasing and say, okay, well, do I need to buy in bulk or do I need to just keep this on inventory, just on standby, and wait for that one person to come along and then it pays out for the rest of the year, right? It depends on what business you're in. There are some businesses like that, but we don't like it. We like frequent purchases, right? Even if it's not recurring, we like the frequency. So we need to understand as investors what are the catalysts that will drive or destroy the industry good service need, right? So what are some things that could totally kill our operation? That doesn't mean we won't invest in it, right? Because we're all taking risks here and we don't know when we're going to fall off the cliff, but we're willing to take a risk if we know we have 5 years of excellent returns and then it'll start to drop off. Some investors will be willing to take that risk. People who invest in OpenAI, now DeepSeek came out, and now it's completely shifted the entire industry's good service or need. Microsoft recently, yeah, I think it was Microsoft or Google, possibly Google, they announced that they're pulling back on their $300 billion AI data center operation, and they're pulling it back to 80 billion as a result of the DeepSeek situation, right? So what are the catalysts that will drive or destroy the industry good service or need? These things fluctuate, right? And we're not in the business personally. We're not in the business of estimating demand. right? We don't care about timing it. We just want to know it exists. We want to know that there's a pool that exists. We're not going to time exactly which month something happens and which month it doesn't happen, right? What we care about is supply so that we know we have some margin of safety buffer naturally from the supply constraint. So we also want to understand why people are buying. Fundamentally, people buy for three different things: health, wealth, and relationships, sometimes entertainment and vice. If you understand these five things, you understand the core drivers of what motivates people to buy, you will understand how you should build your business and your marketing strategy to appease to that niche, right? And then the next thing you want to do is ask, who are the industry leaders and founders that drive this need currently? Because then you can approach those founders, those leaders, and say, hey, let's partner up. And that'll get you to market a lot faster. The way we've gotten our companies to market has been through partnerships, right? Advertisement and all that comes later. But what we do is we drive partnerships. That's one of our strongest competitive advantages. We have a massive Rolodex and still growing. And that's how we have been able to launch several businesses and also take some companies that were doing $500,000 and put them to 2 million in 3 months just because of some phone calls, right? So what have they done or haven't done that makes them successful? When we study people who were at the scene earlier than us, that doesn't mean that we're not allowed to join the scene and compete and say, hey, we have a little bit of a different offer. Hey, we're doing something better. You should join us. But what we want to do is we want to study all the people that weren't successful and figure out why they weren't successful. Because just because you have your first push, your first taste of success, doesn't mean that you're ensuring a 20-year run rate, right? We want to constantly study why people are or are not successful. Then we want to know why we're different. We really want to fundamentally zone in on what makes us unique. What story do we have that makes us unique? Why are we an authority figure? What have we done to say this is something the market is not looking at and it's going to make us special and it's going to make people want to keep coming back to us and buying from us again? What we found is that you should focus on a local geography before going broad. Time and time again, we see people who are trying to sell in 4 different continents, 20 different states. Just focus on one area. If you're going to start making strategic partnerships, keep it in your local area. If you're going to go on podcasts or talk shows or whatever, at least keep it in English if you're an English speaker founder, right? You want to play on your strengths. You want to play on what you've built your entire life on to assist you in growing this company, because this company is almost like your child. It's a reflection of you. You want to use exactly what you've done to push this child to be successful. That's why men build families and want their kids to have the best life possible, because they want their kids to live a different life, a better life, a more advantageous life. And that's how life should be. That's what capitalism is for. It's to build a better future. You should never be satisfied with the future you have right now. You want to always make it better. You want to say, how can I improve this? How do I make this better? And that's the mindset of an entrepreneur and a CEO. Okay, so let's go back to supply advantages and why they are the most powerful competitive advantages we found on the market. Essentially, every single supply advantage is a cost advantage. What you're essentially saying is we have proprietary technology that lets us do this thing cheaper than everyone else. We have better experienced people, so it allows us to do things better than everyone else. We have a superior geography, which means we can, back to our factory example, transport our goods and services to market faster than everyone else, because or at least in the most cost-effective manner. And we have superior access to resources, which means we don't need to import items. Like, let's say you're a government or country. We don't need to import items to produce our finished goods. We have all of that here, so it's cheaper for us. Then you have economies of scale. That's part of a supply advantage. Economies of scale is essentially the ability for you to sustain demand, because eventually you're going to have such a great marketer in your company that everybody's going to want to buy. And you're either going to be forced to maintain the prices and handle more people, or raise your prices because you can't handle all those people. The companies like Coca-Cola, Pepsi, Any consumer packaged good company that can keep their prices stable and reasonable within their target audience, yet continuously hit their entire market or the entire sector of demand, have economies of scale. They are able to scale economically, right? The next supply advantage, and most people don't look at it this way, is having network effects. So who do you know, right? If I can make 2 phone calls and connect my friend with somebody that will help them make millions of dollars, that is a network effect. Life is not a fair game. You think the CEO of Google doesn't know people that will help Google maintain its competitive advantage over the marketplace? Of course he does. That's what the game is. We're human beings. We're meant to come together and work together to try and create things that we believe the market needs, things that we think are super cool and competitive. And that's what the game is, right? We're all teaming up to build something that we think the rest of the world wants, while also simultaneously trying to keep our competitors from copying us, right? But that breeds innovation. And that's exactly how you create shareholder value. Superior access to information, right? There was this book called Flash Boys talking about how Wall Street traders were competing on milliseconds and nanoseconds worth of market data just to get an edge, right? Having information is a competitive advantage. It's part of experience and proprietary technology. Having the ability to produce a lot of things, like most of China's business model, is actually the weakest barrier to entry because they're starting off with commodities, and commodities are priced at the lowest level. It's a race to the bottom. So if you are producing something based on a commodity, you're like the first line in this massive pyramid of finished products and refinement. So the higher degree of refinement, the higher your margins will likely be. So now let's talk about demand advantages. Demand is not really based on branding or differentiation. It's actually based more on having strong customer captivity. And we're going to talk about branding and differentiation. But essentially, maintaining strong demand means your customers have a habit of buying your good or service, right? And it's not necessarily based on brand. I want you to think about it differently. I want you to think about it more from the mathematical standpoint. It's just like, all right, I can go and walk 5 minutes to get eggs at the supermarket, or I can go 15 minutes to go to the natural farmer's market and get some better eggs, right? But I have a habit of being somebody who wants to be efficient with my time. I don't really care as much about my health as maybe somebody else. So I'm willing to just save my time. And also it's cheaper and just get the eggs that I want, because I just want eggs, right? So having a habit over time will make it. And there's this great book called The Power of Habit by Charles Duhigg, which means, and he says that there's a cue, routine, reward, right? So if you go to McDonald's, you smell that McDonald's air that they're pushing out of their facilities. There's a routine. You go and you stand in line, and the reward is you get some salty French fries. So having a habit is actually incredibly um, important. You want to make habitual customers. You want to have people that are coming back. McDonald's is an excellent case study for that. So switching costs, going back to our Microsoft example, it is really hard for certain companies to get off of a provider once they're on them. If you look at IBM, Oracle, Microsoft, Amazon, Google, these guys have made a fortune by making it just too expensive for you to leave them. And that life's not fair, right? That is what it is. Pay the piper. And then consumer preference, right? So this is where branding starts to take more place. But essentially, do customers prefer competing products? Do they say, oh, I'm going to shop around for toilet paper? Or do they have a specific brand that they go to? This is where consumer preference and branding actually matters a lot. But demand still ultimately will be based on price. And that's why we care more about supply. All demand advantages are based on some form of economics. Supply, no, this is the rarest ostrich egg in the world. You're going to pay a fortune to get it. That's something that we think is more impressive in terms of a competitive advantage than just everyone saying, all right, we want milk, we want milk, we want milk, right? Like, It's totally different. It's a totally different mindset, and we prefer the supply side. So we also consider features on products, right? The level of offers that a company can give at a certain price point will dictate how competitive it is. So just like consumer preference, the ability for a provider to offer more things than some other competing product will win more customers. But it is a weaker demand advantage. And then we have trial-based assessment. So we ask ourselves as investors, does this customer need a trial to say whether they like your product or service, or are they just willing to buy because they trust you? And that's a lot of branding. It is a lot of branding. And we're getting closer to that subject. But essentially, we want our customers ideally to not have to go through a free trial to test out your product to see whether they like it. We'd much rather them walk into the store and say olive oil, good, I'm buying it, done. But let's talk about the power of branding. Okay. Branding increases your willingness to pay. You have an emotional connection to it. It'll actually reduce your operating costs. And that's because you'll have employees working for your business at a much lower market rate simply because they want to be associated with your business. It improves the value chain that you might have and that you might be able to offer your customers, because you'll say, oh, well, you've got this small business right here and you're able to provide X, and our business provides 3 times as much as you're providing. So why don't you partner with us and white label under us and be part of our affiliate program? You'll run your business as it is, but you're just going to use our name, right? And that improves the value chain and it compounds over time. Once again, hiring the brand for the job. So that's not just working for the company, but it's actually saying, no, I only want to work with McKinsey for consulting for my $500 million M&A deal, right? And it also creates trust, recognition. People want to be associated with status symbols. So, it's why you wear a Rolex. That's just how life is. So having brand trust and recognition is a massive part of branding. And then it also improves your social status, because if people say, oh, he was a VP at Goldman Sachs, to certain people that might mean a lot, to other people it might not, right? But there is some form of influence happening, and that's why branding is so powerful. It's a tribal part of our human nature. Another competitive advantage is government protection. So the reason why you go to college, the reason why you take a bunch of exams in the financial services industry, in the medical industry, you need to take a bunch of exams and licenses to show that you are competent and to build trust and to show the government that you are constantly educating yourself and learning, that you're smart and you're not dumb and you're not going to screw people over. And essentially, the government will then come in and say, hey, we co-signed that guy. We like that guy. You should go and do business with that guy because he has this piece of paper. It actually matters. I hate that it matters, but as I've gotten older, I think that it does matter. And I'm very glad that I went to college for at least a bachelor's. I don't know if I'm ever going to do a master's, but I'm just very happy that I did a bachelor's, because being able to say I have a degree in statistics and quantitative modeling has some weight to it. I've seen it. It has weight. It shows other people that you have some competence. So that's a form of government protection. It's a competitive advantage. Then you have subsidies. So for charities or any exempt organizations, or maybe you have 2008 situation where the government's going to bail you out, whatever it might be. Government protections overall improve your competitive advantage, because if I'm a private company competing against a private company that does the same thing as me, all else being the same, if one company has the government on their side and the other one doesn't, who would you rather bet on, right? And that's essentially what can create a monopoly, and that's what happened with Standard Oil. So you have Chevron, Marathon, all these different guys, Exxon. These guys used to be part of one big thing by the Rockefellers, right? But now it's not. So government protection might even create a monopoly. So we like businesses that have government protection, because it makes it really hard for you to copy us and take our market share. So all in all, customer captivity and economies of scale strongest competitive advantage. Think about it. If you have a customer who is addicted to your product like crack and you're able to scale it, you have a really good competitive advantage because the branding effects, which are long tailed assets, they take a lot of time, will start to kick in. You'll start attracting more competent people. You'll start building a name for yourself. But they're all based on these two things. Keep your customers happy. I'm actually reading this book right now. It's called The New Gold Standard. And it's about having a world-class Ritz-Carlton hotel experience for your customers. I care about my customers, right? Well, it's the only way we're in business. The only way we're in business is by making our customers happy and also reinvesting the capital appropriately so that we can scale it to a massive degree. That's what I care about. That's all I care about. I don't care about the seasons. I don't care about anything. If I have economies of scale, I have a supply advantage, and I have customers that like me, if there's anything you've learned from this video so far, this is the most important thing. This is the most important thing that I care about, period. So here are some things you can use to eyeball barriers to entry. If we do like an industry map, right? Like if we say like, okay, like what are people solving for in this entire industry? How many gaps are in it? The more you're like, oh shit, like let's say Chase Bank, right? Oh, Chase also does private client banking. Oh, they also have an investment advisory wing. Oh, they also do trading and commodities. Oh, they also do M&A. Like, so how many gaps are in the industry that you're trying to break into, right? The more gaps there are, the more opportunity there is. But typically, most of the time in mature markets, there aren't that many gaps. But if you find one, you'll make a lot of money. I guarantee you that. And that's why we look at returns on invested capital greater than 15%. So when we look at mature businesses, it has to be a lot higher for immature businesses, but in mature companies, publicly traded, every time I invest $1, I should be getting at least $1.15 back. That's one of our mandates. That's what we look for. So high upfront costs for innovation. So it's a lot easier to compete with somebody based on a line of code than it is for us to put $100 million into building a data center plant that relies on a bunch of energy, right? So there are certain games that we cannot play simply because we are financially limited, but also intellectually limited, or any of the other supply advantages limited that we spoke about earlier, right? So you're seeing how this kind of ties together. And then also stability of market share between competitors. So the more stable the market share, the less kind of volatility between the guys that are king of the hill, the harder it is for you to get in. They're not going to let you in. The way competitors interact with each other, the way they interact with their vendors, suppliers, and customers will dictate their future, because we want to see competitors, especially if you're coming into the space, right? You want to start having symbiotic relationships with your indirect and direct competitors. You want to make it a win-win situation for everybody. Okay. Maybe after a certain point, you monopolize and you're so big that everyone's threatened. But even when you're king of the hill, this is what people forget about. You cannot forget the people that brought you there. You cannot forget the people that made you successful in the first place. You have to pay homage to the people that supported you at the start. If you don't take care of your people, I guarantee you're building a skyscraper on sand. It's not going to go well. You need to take care of your vendors, your suppliers, your customers, and your competitors. You want to make sure that everybody's collaborating, because that's what breeds innovation. If everybody's fighting, how can you think about the future? How can you think about making life better? And this is why symbiotic relationships, Pepsi and Coca-Cola working with each other, oh, you don't think they aren't? You don't think they aren't? I guarantee you they are. And there's been books written about this, but I'm not going to go into it for the sake of time. You want to work with people. You don't want to think about things like American Psycho, Patrick Bateman, I have to kill you because you're my competition. I don't think like that. I want to make sure that everybody has a piece of the pie and that people are growing, because people have families, people are taking care of each other. Maybe it's ethical business. Maybe I'm just a baby and I should get a little bit more competitive. But I found that when you take care of people, it pays you back tenfold in the future. So in summary, is the industry growing or declining? Are new companies gaining or losing market share? You should research this before starting your business. You should research this before making an acquisition or doing a merger. Are competitors complementary or rivals? We want to be in business with competitors who are helping us because we're going to help them and we'll grow together and maybe monopolize. Maybe we'll merge one day. So it's never been a fight against each other. It's been a fight against ourselves and our own degeneracy and complacency. And how do participants react to disruption and innovation? So how vulnerable is the industry to disruption? If you're in the AI space, I don't like investing in AI right now. And this is 22525, right? I don't like investing in AI because it is incredibly vulnerable to disruption. You invest in something a week ago and now it's just totally, it's gone. That's it. Because there's something new. And now that's the question, right? Do new innovations create lasting improvements? In the AI space, I don't think they are, right? So people are throwing in a bunch of money, billions of dollars, but are we actually building anything that's long-term sustainable, or is this a new fad? Is this a new idea? And that's really the difference between a bubble and a real systemic advantage for the business, increase in GDP growth, right? Like the difference in .com versus what came after was real value creation. And there's this graph that talks about the smart money and then the dumb money, right? You want to be behind things that are actually producing value, not any of these shit coins that are being pushed all the time. I'm against it. I can't. I'm sorry. I don't care if you're a billionaire from shit coins. You haven't helped anybody. You've taken money from other people, right? Like we want to be in businesses that are constantly producing value, that aren't really subject to change, even though change is always happening. So is innovation moving faster than market demand? That's another sign that, and this was actually cited in that article. I'm 100% certain that this is like a Google thing, but this was actually cited in the article. We're innovating faster than people care about. So you're going to lose money and it's going to slow down the innovation. So there's natural limits to how fast you can innovate, unless you're just a charitable person and you're just trying to make humanity better. Google. So what are customer behaviors? What are consumer behaviors like? Are they willing to change and adopt a new thing like the Meta glasses, whatever those VR glasses? Are people really willing to walk around on the street with them, or do they look kind of silly? So we always have to think about the consumer. Even if you have this really cool product, think about the consumer. And these are some recent studies that we've had based on the firm's profitability. And we found that 10 to 20% of a firm's profitability depends on the industry factors, right? 20 to 40% make up the firm specific advantages. So the industry that you're in, you can't say, oh, the economy's bad and that's why I went bankrupt. No, there's other parts in your business that cause you to go bankrupt. And I've got other videos on that as well. And this video is getting long enough. Firm specific effects, right? What about the firm makes it profitable? Think about that. Is it your team? What other competitive advantages make you profitable? But your brand and your strategic positioning have the most long-term influence on your profitability. You don't plant a seed in the ground and then a week later go and dig it up and say, where's my tree? You plant a seed, you come back in 10 years, and now you have a tree. These things take time. Building a brand takes time, it takes effort, it takes responsibility. And you have to constantly win for your customers, and they'll spread the word for you. Brands only add value if they increase a customer's willingness to pay. So I'm willing to pay you more because of your name and I trust you. Or if they reduce the cost to provide the good or service. So either you're able to raise prices or lower costs because of your name, because of your brand, your reputation. People trust you, you have good credit. That is the most significant part of running your business. So, and we have another video discussing why marketing is one of the last things a CEO founder should focus on, replacing themselves from, because you're constantly marketing your business. You are the brand of your business. I'm the brand of my business. Elon Musk is the brand of his business, and Donald Trump is the brand of the United States of America, right? People represent things. So it's very important to think about yourself as a brand. And it's important to think about your company and the legacy that you're building as its own brand. But that's a long-term thing. You can be a very profitable and successful company just based on your firm. And also if the industry's in a tailwind, you got some push, that's a good thing too. So Thank you for watching to the end of this video. Thank you. I hope you learned a lot. I'm at this point giving professional university level lectures instead of small 15-minute clips, but I've actually really enjoyed the subject and I've really enjoyed discussing it. So I've gotten carried away. If you are a founder, business owner, digital entrepreneur, or entrepreneur in general, and you want to speak with me, you like what we're talking about, book a call in the link in the description below. You can follow me on Instagram at Mr. Grinny. And otherwise, I'll see you in the next one.